This video is very useful for the SEBI Grade A aspirants and also the RBI Grade B aspirants. So I hope that SEBI now comes out with the date of the examination, because it has been such a long time since this examination was scheduled, and I am sure that all of you are still very much worried about when the exam is going to happen. So let's hope for the best and hope that SEBI comes out with the date. And now there's a good news that if you are from the IT or the legal streams, you can now get the paper 2 at Olive Board. So Olive Board has come out with a specific course for that. You can find the link in the description, and of course you can get free mini mocks and also the current affairs capsules that Olive Board brings out. And if you need a complete course for the SEBI Grade A examination, Olive Board has that too. It has study notes, it has live classes, it has mock tests, and all the important things you need to get success in this examination. So you can check it out from the links in the description and in the pinned comment. And let us begin with our video. Hi, this is Shupriyo. Let's start off with SEBI current affairs for the month of June 2020. So the first item that we have today, SEBI Panel recommends non-profits to directly list on SSE or social stock exchanges. Now we have already discussed about social stock exchanges, and it was a innovative kind of a thing that SEBI was planning to bring out, and finally they have finalized all the specifics of it. So the panel that was created for this thing, it was headed by the ex Tata Sons director Ishad Hussain. So remember this name, it's very important. And now what this panel actually found out is that conventional capital that prioritizes financial returns will not be able to rebuild the economy. So we have had a widespread devastation of the economy in the current months. We have seen that the GDP has fallen by almost 24%, and in this point of time, to rebuild the economy, we cannot just rely upon the conventional capital. So the NPOs or the non-profit organizations, they will be able to access transparent social capital via electronic means using this SSE or the social stock exchange. So this type of a stock exchange will be the part of the normal stock exchange, but it will be geared towards these social enterprises. And the social venture funds under the category 1 alternative investment funds may also be used. So the category 1 AIFs, they might also be used to actually help the SSEs, and the social enterprises will be helped a lot by this kind of an arrangement. So this is a very unique kind of a thing that we are going to start off very soon. So let us move to number 2. SEBI penalizes broker in WhatsApp UPSI leak case under PIT norms. So UPSI, we already have talked about these things many times. The unpublished price sensitive information, any kind of information, financial information that can cause some changes in the stock price movements of any company. And the PIT norms, this is basically the prevention of insider trading norms. So the financial results of Bata India Limited and Asian Paints, these were the two big companies which were circulated through WhatsApp. So you can understand this is a gross misconduct, because these UPSI, if it gets out into public hands, then it can cause a lot of issues with the stock prices. And so these big companies were involved in this WhatsApp leak, and a fine of 15 lakh rupees was levied on two individuals, Shruti Vishal Vora and Neeraj Kumar Agarwal of the Antique Stock Broking Limited. So this was the result of this issue that happened, and SEBI has actually penalized both of these individuals. So basically financial details of around 12 companies were leaked in total through WhatsApp messages. So these things, they can lead to insider trading, and a lot of harm can be actually done on a company by doing these kinds of things. So SEBI has penalized them. Number 3, SEBI announces criteria to allow firms to participate in Regulatory Sandbox. So Regulatory Sandbox, we have already talked a lot about this. So what is it basically? It is a kind of system that the regulator gives to these companies to understand whether new products and systems can be developed, and it can be tested on actual live customers in a safe environment. So it's kind of an experimental thing that can be used to test out the regulations. So the firms that actually actually want to do it, this regulatory sandbox, now that SEBI has decided that they are going to go forward with it, they must prove that their idea is innovative and adds significant value to the existing offering and should have a genuine need for live testing the solution on real customers. So if the firms have some kind of a unique approach and they actually require these kinds of live tests, only then they can go ahead and participate in this regulatory sandbox that SEBI has devised. And the project must be test ready and also scalable, and proper risk management strategy, this is also very important, and client disclosure for the risks. So any kind of risks that can happen to the users which will be part of this arrangement, it must be disclosed. And so these regulations and these criteria have been laid down by SEBI, and now we can go forward with the regulatory sandbox. Coming to item number 4, SEBI censors Astrazeneca Pharma's promoters and Elliot Group. So this is a pharma company, and SEBI had detected unfair trade practices in the pharma company's 2014 delisting plan. So it was planning to delist from the stock exchanges, and during this time there was some gross misconduct that was actually detected. So the pharma company, its promoters and Elliot Group, which held 15.52% in the company through 6 FII, which is the foreign institutional investors sub accounts, had a private arrangement to manage the delisting process. So these 6 FIIs, they had a private arrangement, and they actually bought 94% of the stock that was offered via the OFS, or the offer for sale. So basically these 6 sub accounts were actually owned by the promoters, by Elliot Group, and by this pharma company. So they were actually you can say shadow companies, and they were buying up almost 94% of the stake that they had actually offered. So you can understand how it was a very unfair trade practice, and this is why SEBI has censored this company, and this is the entire news. And coming to number 5, SEBI bans 26 entities from markets for 6 months for fraudulent trading. Now all the names of these things are not so important, you just have to remember the happening that this has actually happened. So these entities, they were involved in fraudulent and manipulative trading in the script of PSIT Infrastructure and Services Limited. So this was the company, and they had done some malpractices, they had done some trades which actually caused the share price of this company to shoot up. So the price of this share, it rose from 50 rupees to 466.90 rupees during May 2012 to July 2015 due to this. So due to this manipulation, the share price was actually increased. So these kinds of things sometimes the companies try to do so that their share price goes up, and then they can sell those shares and make a ton of money. And this was what actually happened. And so SEBI has held them in violation of provisions of PFUTP. So this is the Prohibition of Fraudulent and Unfair Trade Practices Regulations. So PFUTP regulations, these were the regulations under which SEBI found them to be violators. And coming to number 6 now, SEBI gives 3 months for unlisted bond issuers to get listed. So we have already talked a lot about the unlisted bonds, and we also just talked about it last video. We said that 10% it has to be reduced to 10%, right? So this thing that they have now come out with, this applies to unlisted NCDs, the unlisted non-convertible debentures, where the mutual funds are investors. So from June 15th, the window will be given to the issuers with unlisted NCDs outstanding as on March 31st. So this is basically just another step to ensure that the debt mutual fund schemes hold only 10% in unlisted debt. Now we all know about the issue that happened with the Franklin Templeton case. I have already covered it in previous videos. Go check it out if you have missed that. And to prevent something like that happening again, SEBI has said that you can only hold 10% in unlisted debt. And the investment limits, we had actually talked about this in previous videos. So you have to reduce it to 15% by 30th September and 10% by 31st December 2020. So by the end of this year, this reduction has to be complete. Now coming to item number 7, SEBI removed Rana Kapoor as Yes Bank promoter. He is now ordinary shareholder. Now this was a very important development in the Yes Bank case, and we have also covered this case in some previous videos. So I hope that you have seen those. Now, banks management had asked SEBI to do this before the planned FPO in the second quarter. So this was the 10,000 crore FPO, the follow-on public offer that they were planning. And because this was actually important to do, because right now Rana Kapoor is in police custody and he would not be able to give promoter commitments and disclosures to the merchant bankers needed before the fundraising activity. So the promoters, they need to give certain disclosures, certain commitments, and this was not possible because he was behind bars, and that is why he has now been removed as the promoter. And just remember this, that SBI, they own the majority stake in the Yes Bank. So what had happened was, as Yes Bank was having a lot of problems in maintaining its CAR, the capital adequacy ratios, and back then a consortium led by SBI, they had actually injected some capital into Yes Bank. So 10,000 crore was invested, and SBI now owns around over 48% of Yes Bank. So they are the majority shareholder in Yes Bank, and so that was the end result, and this is what has happened right now. So we are going to see a lot of different things about Yes Bank in the next months as well, so we have to stay tuned. And now coming to item number 8. Now before we get to this, remember that Olive Board has now come out with an offering for paper 2 for the IT and the legal streams as well. So if you are from the IT or legal stream, you can go to the link in the description and you can get access to paper 2 material, so that's a bonus. And you can also get access to monthly capsules from Olive Board, and also you are going to get free mini mock tests from their site. And of course, if you want a comprehensive course for SEBI Grade A 2020, which has study notes, which has live classes, which has videos, mock tests, and all the important things that you need to get success in this examination, you can check out Olive Board's complete SEBI Grade A 2020 course, and I'm sure that it's going to help you in your mission to crack this examination. Now coming to item number 8, SEBI explores systems to make trading from home a permanent feature. So this is very important because we had talked about in the recent videos that there were some arrangements that were being taken in place so that the brokers could work from home, and now SEBI is thinking that they can do it permanently. So due to the lockdown, SEBI had allowed brokers to operate terminals from home or remote locations. As per SEBI norms, in remote trading, brokers must put up name boards, display stockbroker certificate, etc. But right now they are rethinking all of these things, and they want the brokers to work from home, because in this kind of an environment, it is something that is going to help the brokers and the economy to move forward. So the main issue is to prevent misuses like dabba trading. So dabba trading, remember, this is also a very important thing that you should understand. So this was an arrangement that was very prevalent earlier, but now also it is done, but not at that vast scale. So what used to happen was that these transactions, these dabba transactions, or it is called the bucket transactions, they were undertaken by certain bucket companies. So they used to have people who were just operating these things, like you can say some kind of a casino. They were actually betting on stocks, but it was totally outside the purview of the market. So there was no compliance, there was no client security and all those kinds of things. People used to bet on stocks. If the price rose, then they would make a profit. If the price fell, then they would make a loss. So this dabba trading, this was done parallelly to the main economy, and SEBI actually is very apprehensive. So that is why they do not want these kinds of things to happen again, and that is why the remote working things are a little bit difficult to implement. But now SEBI has thought about it, and they are very sure that they can stop these dabba transactions and they can go forward with the brokers working from home. So moving to number 9, SEBI eases preferential allotment norms to speed up the fundraising. So again, these are part of some changes that SEBI is putting into place so that fundraising becomes much easier for all the companies. So change of pricing norms for preferential allotment will make it easier for listed companies to raise funds in a short span of time. So we know that the preferential allotment, we have already talked about it in previous videos. So this preferential allotment is actually very much important to raise funds at a faster rate, and that is why SEBI wants these things to be a little bit eased so that these funds can be raised easily by the companies. So the promoters, they are now allowed to acquire up to 10% through preferential allotment against only 5% earlier. So now up to 10% they can raise. So this is a significant increase over the last percentage that they had. And also we had talked about this in previous videos, that the time gap between 2 preferential allotments, it has already been reduced to 6 months. So after 6 months, you can go ahead with another preferential allotment. So this is certainly going to help all the companies. Now coming to item number 10, SEBI panel releases report on inquiry and enforcement processes at SEBI. So this was also a very important panel. So the panel was chaired by retired Supreme Court Judge Justice A.R. Dave. So remember the name, very important. So the panel, what did it suggest? It suggested avoiding duplication of proceedings to reduce timelines for passing final orders, so making things a little bit more efficient, and improving recovery processes and interplay between SEBI norms and insolvency and bankruptcy code. So these things, IBC and SEBI, they have to work together so that all the things can be done in a more efficient manner, and better quantification of profits and losses for market infraction penalties. So if any market participant has done something wrong, then we need to have a better quantification for the profits or losses. And these were the main findings of the panel, and they have just released it. Let us move to number 11 now. SEBI challenges CREDAI's moratorium clarification plea as proxy litigation. Now what is CREDAI? It is the Confederation of Real Estate Developers Association of India. So they are a industry body of the real estate developers of India, and CREDAI, they had actually filed a plea at the Supreme Court after RBI granted loan moratorium, asking if it applies to all NBFC loans as well. Now this is something that SEBI was very apprehensive about, and they were very unhappy because they feel that CREDAI is assuming that the NBFCs or the housing finance companies, they can lend to the real estate industry in the future without concerns about current obligations of real estate industry towards mutual funds. So they are very worried that the real estate industry, they have so much obligations to the mutual fund industry and they are not able to pay, and now they want NBFC loans on top of that, and they want a moratorium so that they do not have to pay back the money as well. So this is something that the SEBI is very much opposed to, and so they said that this was a proxy litigation and it should not be entertained by the Supreme Court of India. So that is the entire thing of SEBI. And now coming to number 12, SEBI amends ICDR regulations for stress firms to ease preferential pricing. So ICDR, it is the issue of capital and disclosure requirements. So the preferential share issuers, what do they currently do? So what is the current system that they are following? So they consider two share price figures, the average of weekly high and low for 26 weeks, and also the average of weekly high and low for 2 weeks preceding the share issue. So these two averages they will be finding out, and then preferential share price must be higher among these two averages. So the higher figure is actually selected by the people as the preferential price. But now SEBI has said that because of this lockdown, because of the pandemic situation that is raging on, this 26-week price, this does not actually hold so much importance, and so SEBI has removed this 26-week part for the stressed firms. Now it is only removed for the stressed firms, remember. So who are the stressed firms? They are the ones who have disclosed default on financial obligations for a minimum of 90 days, and they have an intercreditor agreement and a default rating. So these firms, for them, they have amended the ICDR regulations, and now they have some ease in their preferential pricing norms. Now coming to number 13, SEBI facilitates new framework to allow trading in defaulted debt. Now this is a big news, and it's very important because right now bondholders in the defaulted debt are unable to sell it. So D category debt paper is quite illiquid. So understand this kind of a thing very, very well, that right now we have a market for the stressed loans, right? The NPS we can sell, the asset reconstruction companies can pick it up. So there's a market for those things. But for the defaulted debt, the debt that has gone bad, we do not have any market. So SEBI actually wants to create a market for that defaulted debt, and this will actually help the mutual funds quite a lot. So the new guidelines that are going to start from July 1 will allow trading within 2 days of intimation of default by uploading the ISIN master file. So ISIN, it is the International Securities Identification Number, and the intermediaries and depositories will flag the corporate bond database to allow trading. So after they have flagged the corporate bond database, they can allow trading in these scripts. And what this will allow to do, this will allow the mutual fund investors to actually have some relaxation. Why? Because it will create distressed bond market in India, and it will allow the AMCs, the asset management companies of the mutual funds, to repay investors. So understand these kinds of situations, like we saw in the Franklin Templeton case, that the people were not able to actually sell off those bad debts. So now they can have a market by which they can sell it off. And you must be thinking that who are buying those bad debts? Now there are many companies, there are asset reconstruction companies, and there are also stressed funds who actually collect that kind of a debt. And this is a practice that is done in the international markets. In many foreign markets you all see this, but right now in India, because we have complicated laws, we have NCLT, we have DRT, we have so many complications. That is why it has not actually developed so much in India. But if we have this kind of a market, then we can easily get rid of all those debts that have gone bad, and the investors in those funds, they can actually have a relief. So this was the main reason why SEBI has done it. Now moving to item number 14, SEBI amends takeover code by amending the SAST regulations. So SAST, we have already talked about it, substantial acquisition of shares and takeovers. So this will help the investors to get a higher price when an open offer is delayed due to disputes, valuation errors, etc. So we have already talked a lot about the open offers. If you have missed it, I highly recommend that you check out the entire series that I have done on the current affairs for SEBI Grade A, and you'll get to know so much from these videos. You will understand a lot of these things I have discussed in various videos. Now what will happen here is that a 10% interest will be added to the open offer price if the offer is delayed due to acts of omission or commission of the acquirer. So if the acquiring company is delaying due to some reason the open offer, then you can get 10% interest, and this will be something that will be a relief to the existing shareholders. And now currently some acquirers compensate shareholders, but it is discretionary. So the companies that are taking over, they are now doing it if they really want to, but it's not mandatory. But now SEBI has actually made this thing mandatory. Now coming to the final thing for today, stamp duty on mutual funds. So from July 1, stamp duty will be imposed on purchase of mutual funds, including SIPs and STPs, the systematic investment plans and the systematic transfer plans, but not on redemption. So if you are redeeming your mutual fund investment, then you do not need to pay any kind of stamp duty. So the stamp duty rate, it will be 0.005% on purchase or switch in amount, and the stamp duty will be at 0.015% on transfer of mutual funds, like transfers between demat accounts. And also note this, that the short holding periods are more affected. So the mutual funds which are in the tenure of lesser than or equal to 90 days than the longer ones. So the short term bonds that we have, the short term liquid funds that we have, they are going to be more affected than the long term ones. So the people who are investing for the long term, they do not need to worry so much. I hope that you learned something from this video and that it was beneficial to you. If you enjoyed this video, please leave a like and share it with your friends. And if you want to see more of this kind of content, please click on the subscribe button, and do not forget to click the bell icon so that you, my friend, do not miss any future update. I'll see you in the next video. Bye bye.